We stand on the edge of profound change. To meet the demands of a green transition, we need collective wisdom, diverse voices, and bold ideas. Collaboration is the key to unlocking our sustainable future. Together, we can overcome the challenges ahead and seize the opportunities that will define the green economy.
Hi, good morning, everybody, and thank you for being here in this fantastic panel that we're excited about on the fossil fuel dilemma to engage or to divest. Now, we'd like to keep this a more exploratory discussion. The title's a bit more binary for my taste, but it's not about me today. It's about my fantastic panelists who are here. Just to set some context around the discussion itself, there's been a lot of discussion around energy transition and the importance of energy transition across the board. COP28 has heralded the start or calling the beginning of the end for fossil fuels overall. And this has sort of accelerated more discussion around transitioning to a low-carbon economy, phasing out of fossil fuels, and a number of investors are involved in engaging with companies. Some investors are divesting away from fossil fuels, and a number of investors in between. So what we want to explore here today with my panelists is to examine the evolving debate around engagement and divestment. What is the best strategy? Because we all have a common mission in mind, which is to phase out fossil fuels and to ensure a just transition. So with that, I will pass it on to my panelists to introduce themselves. What do you, Catherine?
Good morning, everyone. I'm Catherine Howarth, the Chief Executive of ShareAction, an NGO that does a lot of engagement with companies and mobilizes large institutional investors to engage and drive change, transition in the corporate community. However, I do think the fossil fuel sector is a very special case where the tools of engagement have so far sort of delivered much less than we need. And so that's the special case that I'm looking forward to getting into on the panel.
Hi, I'm Dana Barsky. I run sustainability strategy and net zero for Standard Chartered Bank. Just to say a little bit about Standard Chartered Bank, which will help set the stage, we have 80,000 employees in 53 markets, including many of them in the developing world. And to say we do finance oil and gas, but we also have made a commitment to reduce that financing by 29%. It's an absolute reduction. So that will factor into some of the things that I say later today as well.
Pleasure to be here today. I'm Ita Kettleborough. I'm the director of the Energy Transitions Commission. We are a coalition of leaders from across the energy landscape who were set up to be a high ambition voice for business and civil society in the aftermath of the Paris Agreement. So we spend a lot of our time looking at the shape of a net zero economy, kind of what does it need to look like, what can it look like, and what are the technologies, the investments and the policies that we need to deliver this, working with obviously corporates from energy sectors, old and new, the energy intensive industries represented on our commission, financiers very much represented on our commission, and also civil society, so both academics and NGOs.
Hi everyone, I'm Laura HILLIS. I'm the Director of Climate and Environment at the Church of England Pensions Board. We are a relatively small UK pension fund. We have about 42,000 beneficiaries, all people who either work for or have worked for the Church of England. We manage about £3.3 billion in assets under management, and we've been very active over the last decade in engaging with companies and policymakers and really the whole ecosystem on addressing systemic risks. A very big one obviously is climate change.
Great, thank you very much. We have the panel across asset owners, pension funds, banks, and policy advocates. That's fantastic. So we'll start with you, Ida, in terms of scene setting for what does COP28 entail? What did COP28 entail for the energy transition as a whole, and what does that mean for us going forward?
Wonderful. So 3 areas I thought it was useful to just bring to life before we get into the nitty-gritty of this. How do we drive this transition in or phase down in fossil fuel investment? First of all, what happened at COP28 and why that was important. Second, what is possible and necessary in terms of fossil fuel phase down, big picture, what would we actually need to see in the real economy? And then very briefly, what's needed to make this happen. So firstly, what happened at COP28? COP28 was a massive step forward in one way. It was the very, very first time in over 25 years of global climate negotiations that the role of fossil fuels in driving global climate change was explicitly acknowledged in the cover text coming out of those negotiations. Might be quite surprising that that is true, but that is the reality of where we go. COPs, they're quite like a spider's web. There's almost 200 countries around the table. There's many, many different positions, interests, negotiations. And, you know, some of the people around the table are even at war with each other. And you're looking for unanimous consensus. That's what you have to deliver in that negotiation. So there were more ambitious wordings that were proposed at COP28. People will be familiar with the phrases phase down of fossil fuels or phase out of fossil fuels. What we actually landed on in Dubai was transition away from fossil fuels, which from a diplomatic negotiation perspective is a weaker form of words, so we can't pat ourselves on the back too much, but it was a major, major landmark step forward that can, and I think should, be celebrated. So that's the context of what we did achieve. In terms of what's possible and necessary for fossil fuel phase down, before COP28, as part of the kind of push to get that commitment at COP28, we did a major piece of work that summarised what we think can and must happen. And the crucial thing here is that we are not talking, and I'm sure people in this room are aware, but just to be clear, we are not talking about incremental change in fossil fuel use. We are talking about a major, major transition away. By mid-century, coal use can and must fall by 80 to 85% versus 2022 levels of coal. Oil by 75 to 95%, gas by 50 to 70%. Where did we come up with those numbers as the ETC? Well, it was actually the synthesis of around 7 years of work following our founding after Paris, where we looked at both what the climate science, what the IPCC tells us we have to do to limit global warming, and we also looked sector by sector at what technologies can be used to provide the clean power we need. And we concluded, and we really strongly believe, that it is technically and economically feasible for us to deliver this transition. The technologies that we need to replace fossil fuels are progressing faster than we thought was possible 5, certainly 10, 15 years ago. In the power sector, wind and solar are now the cheapest form of clean energy generation. In road, we can move away from burning petrol and diesel in all of our cars to EVs. Like, these technologies are there, and sector by sector we can see it. So if it's possible and it's necessary, what do we do about it? And I guess there are many actors, there's many roles, but just 3 key ones to highlight to kind of frame the discussion today. The first is, we do believe that on global commitments like COP28 are important. They set this vision, they set the direction, and we really need to maintain and extend this commitment at the coming COP. I'll be there next week in Baku, trying to advocate for that, and also in Brazil, which is next year, and beyond. And potentially, given the news this morning, this is going to be even more difficult, but even more necessary to try and maintain that consensus that was imperfect, but was a really important step forward. The second thing is to really emphasize the role for governments. Governments have to be putting in place, sector by sector, the policies that are going to drive down fossil fuel demand. We need the phase-out dates, the regulations on emissions intensity, the carbon pricing, but also the positive policy, so gigawatt targets for renewables and solar. What are we building instead? Because without this scaffolding, on a sector-by-sector basis, it's really difficult for the finance to flow at the scale and pace that we need, and that's really crucial. So big message for us remains advocating to the policymakers. And then finally, that critical role for financial institutions. Clearly, finance flows across all areas of the economy. We really believe financial institutions can be a driver and accelerator of the transition. And there's lots of different options about how they can play this role, guardrails around fossil fuel financing, what is and isn't finance. For instance, we would say there is no justification for financing of any new coal exploration. We already have the reserves that we need to burn from now until mid-century. Very tight restrictions on financing for oil and gas. There's strategies around managing the financed emissions of portfolios and collaborating and working with portfolio companies. We can go into this at depth. I think this is what we're going to discuss, but a really crucial lever for getting that finance to flow at scale and enable that transition to happen.
Great, that's fantastic. Thank you, Ada. So you're picking up on the third point that you just made on financial institutions and engagement with companies, both with the emitting companies as well and their financiers. So it's a question to all speakers across. So when we talk about engagement strategies or stewardship strategies for these companies, where would you personally stand, or as an institution, where would you stand there? And how do you see the debate having evolved over the years? So getting a little bit of a flavor from each one of you on both the where does engagement stand, how has escalation evolved, and what are the areas of improvement or key areas? If you were to pick one, what would that be? So that would be, maybe start with you, Catherine.
Okay. So look, I just want to put in context the position of fossil fuels within the global capital markets. They represent 5% of total equity markets, but their products are 70% of global emissions. And so that 70% is that 70% of global emissions produced by fossil fuel companies and their products is doing enormous long-term damage to 95% of the rest of the equity market. It is putting everything else at risk. So this is a fundamentally anti-social industry that continues to be the beneficiary of investment from all our pension funds every month. If you put money in a pension fund, it's flowing into the fossil fuel industry, and that industry is crowding out the growth of renewables. So at the moment, we've got energy demand growth in the global economy, about 8 extra joules a year. And for the last 10 years has been made up more by fossil fuel growth than renewables. But renewables are growing rapidly and can make up the extra energy demand we need going forward. So fossil fuels are crowding out the renewables industry, and that is doing serious long-term damage, not just to all of our lives, but actually to our pension funds and to our financial prospects. So this really is an industry that sees an existential threat. There is an existential threat to the fossil fuel industry of transition, and we need to treat it really differently from the way we treat other industries with whom we do engagement as investors on transition. So, you know, the demand side industries, the chemicals industry, the built environment sector, the industrials in general, all have a rosy future if they make a transition. And it's in our interest, in our pension funds and our asset managers to be, and the banks, absolutely, that finance all of those sectors in the real economy that have a transition journey to make, to support them in making it. And that requires, you know, strong engagement by equity holders and bondholders. We'll come on to bondholders in a minute. But the fossil fuel industry is a different case and needs a different playbook. And I do think that we need to take a far tougher line, and that honestly we're being a bit let down at the minute by the institutional investors that look after our money that have sort of engaged with effectively bad faith actors in the fossil fuel industry who've been very happy to have people come and chat at their AGMs and raise these questions and form coalitions and come along. And it's just stringing it along. It's a game they're playing, and we need to call it out. And we need to take a much tougher line, I think, with the institutional investment industry that looks after our money. Now, I just wanted to highlight really quickly one of the things that we're very excited about and love working with you on, Chandra, which is the role of institutional investors as bondholders in these large industries, because it's through the bond markets and through the banks, of course, that companies get working capital and renew their capital stock all the time. And that offers a huge opportunity for influence. And so whilst a lot of the engagement game is focused on equity holders, and there's, as I say, a really important role for that, particularly in all those high carbon industries that need to transition and really need strong support from their equity holders to do that, it's the bondholders that I think can really hold feet to the fire and need to absolutely up their game, which is starting to happen. And institutions represented on this panel, I think, are absolutely in the vanguard of this. So most of the engagement game has been left to the equity investors. That's a mistake. The urgency of this transition requires a much more focused approach on the bondholder power and their tools and tactics, as well as the shareholders. And in particular, I'm looking forward to hearing what the comments on the banking sector. But the banks are stepping up, but definitely need to accelerate the toughness of discussion and the policies they have on the financing of the fossil fuels.
I couldn't agree with you more. No, I think your point is an important one, that the way that investors engage versus the way a bank can engage is quite different. As a bank, we have the ability to not only put covenants in our lending agreement, for instance, to try to force a company to transition, but we work closely with the company. We are there by their side. We have access to their business plans. We understand what they can and cannot finance, and we work much closely with our clients and often have inside information. That being said, I'm very much in the camp that we need to work with our clients, and we try as hard as we possibly can to work with them within the boundaries of what they can and cannot afford to help them transition as quickly as possible. We will offboard clients who refuse to transition, but first and foremost, we believe we need to work with them to help them transition and be ambitious. As an international bank with very high standards, we feel it's much better for us to engage with clients than simply pull our capital back and divest. Because if we do, they will just go to usually a local bank that may not be as ambitious, and that doesn't do the world any good. So engaging with our clients to help them transition, we feel, is the best way that we can make this transition accelerate and be more successful. Now, I mentioned earlier that we do have an absolute reduction, and so as time goes on, if our clients are not transitioning, we will have to pull back our lending. And so it is a balance that we as an institution make to try to be as ambitious as possible, frankly.
That's really helpful. And I just want to pick up on a point that Catherine made and you made as well, where it is about the difficulty, and there is a certain element of disillusionment that has been faced with lack of progress from some fossil fuel companies in particular. And from your side, where you say you have to work with clients, we need to engage with clients because this is our business, this is what we do. So I think from a balance perspective, I mean, I'd like to invite Laura in for the discussion on, at what point what does that journey look like? You guys have had an experience with engagement and with going forward. So yeah, would love to hear your views.
Yeah, no worries. I'll start by saying I'm a massive advocate for engagement, and I find that I often get invited on these panels. Sorry, that's my phone, I'll get it later. I get invited on these panels because the Church of England made a pretty big announcement last year that we'd divested from the oil and gas sector. And I think people expect I'm going to full-throatedly argue for divestment, and I absolutely don't. For context, I was one of the people who started Climate Action 100+, which is the biggest investor engagement initiative on climate change that exists. I worked on that for 5 years in Australia before moving over here and spent that entire time engaging with fossil fuel companies, mining companies, big emitters, and I still really firmly believe that engagement can work. So the Church of England has engaged with fossil fuel companies and on the issue of climate change for about a decade. And we decided in 2019, in part because we were looking at the information on climate change. This was a few years past the Paris Agreement. We were part of CA 100+, and so we'd been doing this for a while. And we made a decision that for our engagement to be defensible, we needed to put really clear parameters around it. And the reason we did that is, to your point, Catherine, which I think you articulated brilliantly, there is a lot of very average engagement going on right now. You know, there are a lot of investors that are saying, no, we're not going to divest, we're going to engage. And I support that, right? I think that makes a lot of sense. And to your point, you want to be able to actually tell the companies what you want. If you have that stake, and as an equity shareholder, you have a stake, you're able to vote, you're able to go along to AGMs, you're able to make statements. So that, I think, gives you a lot of power and influence, which is really important. But then you actually have to use the power and influence that you have to tell the company what you want them to do. And unfortunately, too few investors are actually doing that. So what we did in 2019 was we said, okay, if we want this to be defensible, we have to be very clear about what we're trying to achieve, and we have to put some timeframes around it. And so what we said was we'll do this for 5 years. By the end, if the fossil fuel companies haven't met specific milestones that we have set, and we used data that you were referring to, so we really looked clearly at what the decarbonisation trajectory looks like for oil and gas companies. We do this across all of our companies. We basically will set milestones that get you on that 1.5 aligned or Paris aligned pathway and go, if companies aren't meeting that, then we'll have to have a rethink of this. And so what we did for the oil and gas companies was said if they didn't meet specific transition pathways by the end of 2023, and we actually said below 2, so it wasn't even 1.5 if anyone's thinking, gosh, that's unrealistic. It was below 2. And we basically said, okay, if they're not on these pathways, we used independent data to do that assessment. And during the 5-year period, we engaged very intensively. So for some of those companies, we were meeting with them every couple of weeks. This was a very intensive engagement. The vast majority of that happened behind closed doors. So that's very much meeting with the company, meeting with sustainability teams, meeting with management, meeting with the board. We also went along to AGMs, we made statements. We very publicly backed the first transition plan from Shell, which came out in 2021, because we felt like it was a really important step forward that these companies had started to put out transition plans. That was really one of the first transition plans we'd seen. And so these engagements went on for a number of years, up and down, and then in 2023, we did the final assessments. Interestingly, in 2023, if everyone can cast their mind back, what we were seeing was actually pullback from the companies. So a lot of the companies had actually started to reverse their targets. So in many ways, they made our decision a lot easier because we realised that fundamentally, A, the companies weren't aligned in terms of the milestones that we had set for them. But secondly, they were actually starting to change their rhetoric and go, well, actually, we're not so sure that we're on this pathway at all. And we're not as committed to it as we maybe had thought that they were. And I think that the thing that's really useful about this example is we don't see this as a success. I want to be really clear about that. We occasionally get people contacting us and saying, we'd like to give you an award for divesting from these companies. And our team internally go, absolutely not, please don't do that. We do not see this as a success. We see this as a failure of engagement. We tried really hard. We used the tools we had available to us as equity investors. We filed resolutions on different topics. We engaged. We spoke to the boards. And ultimately, we didn't get the companies to where we wanted them to be. And that was why we took the decision to divest. I'm happy to talk a little bit more about some of the things we feel like we could have done differently, if that's helpful, but I'll leave it there.
I think, we'll definitely come back to that in a couple of minutes. We need to leave 5 minutes for Q&A, but I just wanted to touch on some of the things you mentioned. It's clearly a very, very structured 5-year journey that you guys have had in terms of targets, in terms of asks, in terms of what you got from the companies. I'm wondering from a banking perspective, is that when you look at working with clients to make them or help them transition, what does that process look like, and what does that and have there been instances of sort of pulling back from financing because they haven't met certain targets or anything else?
Yeah, no, absolutely. Look, every situation is different, so it is very hard to generalize. I mean, I think it's really important to make the distinction between an oil and gas company operating in this environment here in the UK versus in some of the developing world as well. it's important to keep in mind hundreds of millions of people don't even have power, right? Are living off the grid in places like Africa. And so they need oil and gas, for the country needs it to, provide power to their people. And cutting back financing there is not necessarily in the benefit of a just transition. So in countries like that, what we try to do is to finance as much renewables as possible. But as Nigel mentioned earlier, that's not easy from a cost of capital perspective. So what we need is de-risking. And so what we will do is try to work with MDBs or DFIs to try to accelerate renewable investment alongside of oil and gas investment through blended finance or other de-risking capital structures, to try to do that as quickly as possible. But it's another interesting thing that we've seen, which is politics play a big role here, which is, the politicians in different countries who approve these, they need energy for their people. And it's really important that you try to accelerate the investment in renewables in a way that doesn't limit their power. And I mean both political power and also the power for their people. And so that's one of the ways that we try to engage in the developing world. And with our conglomerate clients, we also really encourage them to make investments in renewables, to look at other variables such as methane as another really important, and to live up to the commitments that they have often made publicly to ensure that they are doing what they are saying they're doing.
I just want to leap in and make a bit of a challenge, because I think it's really important to be clear that we do not need more fossil fuel production to meet global energy demand growth. That's a line. That's a line from the fossil fuel companies. They have every interest in projecting the idea that we aren't going to meet global energy demand in the global south without more of their products, which are deeply destructive to the long-term well-being of people in the global south and here. So, no, we really have to take a much tougher line with the people that ultimately sit behind that, which is our pension funds. We've got to be really clear that we're all, in a way, part of this story and can be really empowered around it. Because our pension funds invest not just in the fossil fuel companies, but also in the banks. The banks have choices to make, but they need their shareholders behind them, as well, of course, of government. This is absolutely a policy play as well. But let's, on the day that Trump got reelected, we actually really need to step up this game of saying we can be citizens in the economic and financial sphere, and we absolutely need to send these messages to our pension funds that they're putting our capital at risk and our futures at risk when we keep supporting the fossil fuel industry to keep expanding. It's just irrational at this point.
But Catherine, you do see the difference between the difference of the different economies between developed and developing.
I do, but I just think that that's there will be some very, very limited exceptions, but we have to be much, much clearer on, we're out of time for that now. We absolutely need to rush green finance into the developing economies, and we can do that together, and we have to be really clear that that kind of financing is in the interests of all of us as pension fund members, because you put money into a pension fund, it's years till you'll be drawing out. So it's really irrational to be focused on what might make a quick return in the next few years. We have to take a prudent long-term approach to that.
I think I would echo that in terms of, I think one of the things that we see is the confusion around the relative orders of magnitude of some of these things. So on a discussion where we're talking about the fossil fuel industry as a whole and the massive phase out, phase down of fossil fuel we need to see, this is not a story primarily about sub-Saharan Africa. We have a program, we partner with WRI, we've done a massive piece of work looking at how the clean economy can accelerate energy access. Absolutely agreed, massive challenge around cost of capital. There are some very exciting programs. We can channel money, and we can actually see that through the huge cost reductions in especially solar and batteries as a combination, that we have this really exciting opportunity to provide energy access much more effectively than the fossil fuel industry has managed to provide energy access in sub-Saharan Africa. So it's absolutely crucial. I completely agree that it is critical and we shouldn't forget and play a blanket rule. But at the same time, we shouldn't focus a discussion which should be about the transition of the majority of existing fossil fuel production, which is not in these contexts. And we should be focusing on how we drive that and not let the important and critical kind of story in sub-Saharan kind of cloud the larger messages, which is we have the technologies across the world today to transition away. And if we don't hold ourselves accountable as financiers, but also I think the bit I would add is financiers who want to be engaging in this debate and want to be having the kind of really structured long-term conversation that you've described that you went through with those fossil fuel companies that you were working with. Those companies that want to do that also need to recognize that engagement, and I'm sure, in fact I know you also do this, but engagement with broader society is also important, because if we don't have the engagement with policymakers, if we don't have the engagement with wider civil society to say we need the policies sector by sector that give the scaffolding that show we are serious about moving away. In steel, we will be moving away from coal-based steel production, blast furnaces. Will be moving to clean technologies. In road, in home heating, we are going to do this. Here's the targets, here's the technologies, here how we're going to roll it out, because those signals are meaningful not just to the financial institutions that already want to engage, and the investors that want to engage, but also drive actions of those investors that aren't convinced, because they might not be convinced themselves they want to engage, but if there are clear sectoral targets, if there are clear mechanisms, then they have to acknowledge it might not be in their short-term interest. So for me, it's focusing more on the bigger part of the problem and less on some of the exceptions that we need at the moment.
That's very clear, Ida. Thank you. So unfortunately, that's all we have time for. We're going to have to move to Q&A at the moment. We can take 2 questions. So we'll start with yourself.
Hi, Dr. Bonahis Oko, Sustainability Lead for Canon. I hear statements like this. We absolutely have to rush finances to sub-Saharan Africa to ensure a just transition. We have the funds. We need to engage with policymakers. We have the innovations and things like that. But there is that gap between we have to and actually doing it. And as a Nigerian, the singular source of revenue in the country is oil and gas. Yes, has it devastated the nation with spills and things like that? Yes, and that was why I got into sustainability. Still, there is that gap. And when we sit here in the global north saying we can, we should, but there is nothing happening on the ground, how do you engage? How do you ensure that that gap is closed? Because there are people who depend on this, whose entire livelihoods depend on it. So, thank you.
Yeah, I'll jump in after you.
Okay. My short answer is, again, we have to use all the levers, and for us, and it starts with the COP levers, so the global commitments. It is unacceptable that we do not have meaningful climate finance flowing. It's one of the topics, the new collective quantified goal, the NCQG, that's on the slate for COP 29 this year. We have to get the MDBs alongside the private sector to be catalyzing that investment into those countries. And we can't have statements around fossil fuel phase down without hand-in-hand statements with concrete flows towards the alternatives. So I think it's really making sure that those are in lockstep, and we can do that. We should do that, and we have to keep pushing our leaders to step up and do that.
Can I just add something? So I think it's appalling that what has happened in emerging markets is we've created this idea that, yes, you can have development, but you can only have it if we impose this sort of neo-colonialism on you, where you're forced to have these big fossil fuel companies they're the only option for your economy. I think that's appalling, and I think what happens in some of these multilateral processes really needs to change so that emerging markets actually have genuine power and genuinely able to actually craft the future that they want for themselves. I think that, back to the point on the fossil fuel industry and how it has crafted this message around fossil fuel dependency, the amount of money, time, energy, resources that fossil fuel companies and lots of other companies, might I add, agriculture does it, the autos industry does it, put into lobbying and put into crafting these messages that people see on their TVs, and they've become very persuasive in lots of different countries around the world as well, that somehow we're dependent on these industries for our economy. It's not true, and it's not right, and I think investors have a really big role in actually calling it out a lot more.
Yeah, that's really well said. Every country, this one included, Nigeria, we all need national just transition plans, because there will be in any economy a mixture of short-term and long-term winners and losers. What I've tried to emphasize is that we're all long-term losers if we don't get a very accelerated transition underway, and we cannot allow the fossil fuel industry to stand in the way of it. But a country like Nigeria has a huge need for a kind of democratic, collaborative, as we need everywhere, process of discussion, which brings all stakeholders together to figure out a pathway. Because, like our country, it's a very unequal country where different people have done well out of this and still suffer extreme poverty. So I think we need, which brings me to a general point, which is that, we can't have a technical discussion. We need a kind of citizen-led model for how we figure out the pathways forward, because they're tricky in many places, and your country would be one of them.
Let me just comment. First of all, thank you for that story. I think it's important for people to hear that. And as a bank that does finance, financing in Nigeria, I would love to see the grid leapfrog into new technologies. And I think some of the points that were being made as costs are coming down in these new technologies, I think there's an opportunity there. But just to stress, what we need is additional de-risking through MDBs or governments, and we need policy. We need stable policies that are supportive of this type of investment. If we get those two things, we're very willing, to finance renewables at scale, and that's very much what we're trying to do.
Great. No, thank you very much, and thank you for all the questions and to our panelists for the fantastic insights. That's really helpful. Thank you very much.